Have you ever looked at your credit card statement and wondered why the numbers seem to climb so quickly, even when you are making payments? Credit card interest charges can seem high primarily because they are tied to a combination of factors, including the inherent risk lenders take, the unsecured nature of the loan, and how interest compounds daily. First, credit cards are considered unsecured debt. This means there is no physical asset, like a car or house, for the bank to take back if you do not pay. This higher risk for the lender translates into higher interest rates to compensate for potential losses. Secondly, credit card interest often comes with a variable annual percentage rate, or a PR. This rate can fluctuate based on market conditions, like the prime rate, which is a benchmark interest rate set by banks. When the prime rate goes up, your credit card PR can follow, leading to higher charges. Finally, interest on credit cards usually compounds daily. This means that interest is calculated not just on your original balance, but also on the accumulated interest from previous days. It is like earning interest on your interest, but in reverse, making your debt grow faster than you might expect. To keep these charges in check, always aim to pay your full statement balance by the due date. This way, you can often avoid interest altogether, thanks to grace periods offered by most cards. If paying in full is not possible, try to pay as much over the minimum payment as you can. Even a little extra can significantly reduce your principal balance, which in turn lowers the amount subject to interest. A key term to understand here is your credit utilization ratio, which is the amount of credit you are using compared to your total available credit. Lenders often see a high utilization ratio, typically above 30%, as a sign of increased risk, which can influence future interest rates or credit offers. Also, remember that making only the minimum payment means a large portion of your payment often goes straight to interest, barely touching the principal. This extends the repayment period and increases your total cost significantly. Understanding these core mechanics of credit card interest empowers you to make smarter financial choices. By focusing on timely payments, reducing your balance, and being mindful of your credit utilization, you can effectively manage costs and build a stronger financial foundation for your future.